And welcome once again to Investor's Edge. I'm Adam Sarhan, in for Gary K, who's out today. Today is Monday, May 4th. May the 4th be with you, my kids at school are saying, so I'll share that as well. 2026, and as always, we have a great show for you tonight. I want to thank you very much for being here. Just some housekeeping before I dive in and give you Gary's notes and my thoughts on the market and the latest headlines. A week ahead is going to be the topic for today, and just set the stage for what's coming up. But first, some housekeeping. As you know, this is a show about you and your money and all of the fun points in between. If you don't get the show in your city, you can go to GaryK.com. You can listen live or archive. If I tend to speak fast, you can pause it, rewind it, listen again and again and again for free on any device, all on GaryK.com. You can also follow Gary on X, formerly known as Twitter. You can subscribe to Gary's morning notes sent directly to your inbox for free. You can ask Gary about his money management services. If you want his premium subscription, you can join convictionleaders.com. Once again, convictionleaders.com. He does a great job of updating members throughout the day, does webcasts just about every day, and shares a lot more. So you can not only hear Gary, what we do normally is listen to Gary, but you can also see the charts and see him go through what he sees and see the market from his point of view, which for me is very helpful. So all of that's available at convictionleaders.com, and I believe you can take a free trial there. All right. So again, week ahead is the topic for today. Before I go into the details, I'm going to read you some notes from Gary to make sure I'm the messenger and I do my job and get the message across to you. First off, transports, particularly weak, and they're getting hammered. Federal Express, UPS, they're really coming after the truckers now. Oil prices are spiking, and the 30-year yield is above 5%. So, or it was during the day, so we'll see what happens there going forward. But you guys already know Gary's been bearish on housing, retail, and a bunch of other areas. So again, just to mention high level, just watch those transports. It's important because the markets, we spoke about this before last time, is a mirror of the economy. So financials are getting hit, transports are getting hit. That tells us a lot about what's happening on Main Street. We can also mention, let's talk about some of this is from Gary, some of the AI semiconductors and others ignored the Dow drop earlier. So high level, just pay attention here to the narrowing areas of what is working. This is Gary's notes are done. The rest of this is going to be me now. Well, those are the notes from Gary, so let me end that, and I'll say the rest of this is me going forward. So it's really important paying attention to what is working and what's not working in the market. I always like to say the market is speaking and then ask, are you listening? The market's not literally talking to us using words like I'm using now, but what is the market doing? It's speaking to us by its actions. What areas are up? What areas are down? What areas are leading? What areas are lagging? So on and so forth. Movers on any given day, a lot. There's so much. So how the market speaks to us, price, volume, so on and so forth. Groups, themes, trends, etc., etc. But that's how I listen to the market. Just pay attention to what's actually happening. Not what people say might happen or this, that, and the other thing, the news, the headlines, all that. Sure, fine and dandy, no problem. But what's actually happening? The what matters more than the why. Anybody can have a reason for why something is happening. The market's up because enter any reason you want. What matters on my statement is what is actually happening, and that's the price. And that's why, for me, price is primary and everything else is secondary. So up ahead this week, I think about 20% of the S&P 500 companies are reporting earnings. That's a lot, folks. 20%. Last week was a heavy earnings week. This week is another heavy earnings week. I believe it's peak earnings last week, this week, and over the next few weeks. This is the thick of it. Like, we're in earnings season now. And we had some Federal Reserve speakers today. There's a Milken conference where a lot of the big Wall Street guys and gals go to talk. But really from earnings, we have Tyson Foods, Lowe's, Palantir reports, Veritex Pharmaceuticals, Pinterest, Duolingo, On Semiconductor, Diamondback Energy, and more. That's Monday. Tuesday, we've got the March JOLTS job openings report and April ISM services or non-manufacturing PMI index. Those are the economic data for tomorrow. And then earnings tomorrow: PayPal, Pfizer, Cummins, KKR, Marathon Petroleum, Global Foundries, AMD, Arista Networks, Supermicro, Electronic Arts, Occidental Petroleum, and many others. Wednesday, another Labor Day of focus. We've got Labor not Labor Day in September, but heavy labor data day. Let's put it that way, right? Labor data. Let's put it that way. You have before the open April's ADP non-farm employment report, which is a private jobs number, and that's from ADP. As far as that's economic news, earnings news on Wednesday, we have CVS Health, Disney, Uber, Apollo, Kraft, Oscar Health, DoorDash, AppLovin, Fortinet, FTNT, Snap, Zillow, Warner Brothers, IONQ, Beyond Meat, and many others. Thursday, we have more Fed speakers coming out, and then earnings from, let's see who's reporting Thursday. McDonald's, Datadog, Peloton, Warby Parker, Tapestry, Coinbase, Airbnb, Affirm, Cloudflare, Lyft, and many other companies. That's Thursday. And then Friday, we have the always fun jobs report. Why does that matter? Because that's the official report from the government, tells us the unemployment rate, tells us jobs, if employers are creating net, jobs are contracting or declining, contracting or expanding, or however you want to expand, either going up, jobs are going up, or going down. Really, that's all that matters. From the jobs report on Friday, at the end of the week, we're going to have about 20% of the S&P companies reporting earnings. We're going to have better data on employment. And why does that matter, folks? Because the Fed has a dual mandate. Number one, make sure unemployment stays relatively low, jobs continue to grow. And number two, inflation stays around 2%. That's it. Everything else is noise. That's the Fed's mandate from Congress. So when you look at the jobs report every month and you look at other jobs data that comes in, like I just mentioned, all that other stuff that's happening this week on the jobs front, that's literally half of the Fed's mandate. It matters. I mean, what is the Fed looking at? It's looking at the jobs, looking at unemployment. It looks at this data. And then the second thing the Fed looks at is inflation data. All right, oil's going up. What does that mean for inflation? Not just oil. Gasoline prices are going up. Gasoline at the pump. Prices are going to go up. I don't want to be the one to tell you. I'm just the messenger, but that's most likely what's going to continue to happen here until oil prices and gasoline prices start coming down. Until then, what's happening? Gas prices going up. Inflation. What does that mean for inflation? Up. So again, when you understand how this works, it's no longer a matter of like, oh, okay. It's like, oh, this makes sense. That's why this matters, because it goes back to the Fed. And ultimately, what is the Fed going to do with interest rates? That's powerful. Because once you understand what the Fed does with interest rates, now all of a sudden, you can look at the signals, not the noise. Elon Musk has a great line. Steve Jobs had this years ago, where there's lots of things happening in the world and in their viewpoint every day. It's really important to focus on signals which actually move the needle and filter out the noise. Otherwise, we get lost in the sauce, like my friend Andy says. You get so much noise, all this happening, bop, 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 and most of it doesn't even matter. Signals. What is the Fed, which is the proverbial elephant in the room, looking at? It's looking at employment, looking at inflation. That's it. All the other data, sure, it's important, but it's a backseat from the Fed standpoint. And again, economic data is by definition a rear view mirror phenomenon. It tells us what happened in the past. Earnings. All of these earnings companies that are coming out this week with earnings told us what happened in the past. But the market's a forward-looking mechanism, and that's a major disconnect for most folks until they understand it. Then all of a sudden, oh, wait a minute, what? I can look to the right of the chart? This makes actually sense. Like the market's looking forward. It's discounting the future. And economic data, earnings data tells us what happened in the past. That's important. Don't get me wrong. Earnings data is important. Economic data is important. But really, going forward. So you tell me that inflation was low 3 months ago. Okay. But 3 months ago, oil was at $60. It's now over $100. That's not going to mean that inflation is going to stay low tomorrow going forward, right? The next time you take a look at inflation, it's going to be up. Well, okay, then the Fed's going to adjust. So the narrative coming into the year was, hey, the Fed can cut rates and blah, blah, blah. New guy coming in after Powell leaves, cuts rates. Trump said cut rates. What if inflation goes up? And there's something called stagflation, which means you have an environment where inflation's up and growth is down, and that's not a good environment to be in. But that's kind of what could happen going forward. But the market, for now, dismisses that. Okay. I said recently, and Gary's mentioned many times, the market's so extended, it's due to pull back. Okay, so we're pulling back. It's just one day today. Okay, let's see. How long does this pullback last for? Is it an aggressive, heavy selling, heavy distribution, fancy schmancy word, which just means heavy selling, institutions are selling on volume? Or is it a very low contained pullback? So far, it's a low contained pullback. If we start seeing down big percentages on big volume in the major indices, day in, day out, or heavy down days on heavy volume, that's considered distribution days. But right now, after a big move up, the market's extended. It's earned the right to pull back and consolidate some of this move. And even with oil prices so high, the market's barely budging. Up next, we've got a lot more to cover. I believe that's all the time we have. And welcome once again to Investor's Edge. In case you're just joining us or missed any part of the show, you can go to GaryK.com, rewind, fast forward, listen at your convenience on any device. In case the timing was off a few minutes ago, we had that figured out. There was a technical difficulty, so thank you for your patience. Going forward, so we talked about the market. We talked about what's coming up this week, the fact that employment is a big focus this week on the economic front, and we spoke about the fact that in really a lot of earnings are coming out. It's just that simple. So we've got earnings, we've got economic data, jobs. Now, what matters? The Fed matters, what they're going to do next, and they're going to look at inflation, they're going to look at jobs. Earnings data, when it comes out, that matters because we're going to have winners and losers from earnings season. How do you determine when a stock is a winner or a loser during earnings season? It's by looking at the reaction to the news. And what you look for, basically, and the easiest thing to look for, at least what I do, is I look for stocks that gap up on earnings. That's it. And gap up big. And when we're in that situation where the stock gaps up big on earnings, even if the earnings numbers are not the best, the reaction to the news in my world has more of a weighting than the actual news itself. Because lots of times I've seen stocks where they have crummy numbers for whatever reason in that quarter because of whatever, they had to take a hit or something happened, but their guidance is super strong or whatever positive thing happens going forward. And guess what? The stock has a huge gap up on earnings, which is a catalyst, and then it continues to run. And the converse is also true. I've seen stocks gap down big on earnings and they continue to fall. Now, sometimes it's rare, but sometimes they have a huge gap up and then they sell off hard, or a big gap down and they rally right back up. Again, depending on the overall market we're in and where we are in the cycle and so on and so forth, there's examples of everything. I mean, just how the market works. Nothing's 100% locked that I figured out. Maybe there is something. If there is, please let me know. I'd love to hear it. But again, this is all about stacking the odds of success in our favor, the probability. The future, by definition, is unknown. Same with the market, same with life. If you would have asked me in 2019, though I think the world's going to shut down because of COVID, even early when COVID first hit, before the shutdowns and the lockdowns and all that, is the whole world going to shut down? I'm like, yeah, no. I've seen this before, mad cow disease and this, that, and the other thing, chicken, bird flu, and whatever, all this other stuff. Yeah, the world's not shutting down. That's what I thought when COVID first hit. But guess what? It did. Probabilities, folks. Risk, reward. So again, when you look at markets, look at earnings as we make our way through earnings season, I want to focus on a few things. First, the reaction to the news. And how do I organize all of this? It took me years. I used to do it by hand, and then I did it with technology. I keep a spreadsheet. Now I just automated the whole thing. And I built a tool that I use, and you're free to use it too. It's called marketterminal.com. You can take a free trial. If you like it, great. You don't like it, that's fine too. Big Wall Street firms, hedge funds, institutional investors, family, all the big top 1% of Wall Street, just about all of them use terminals to win. So I'm like, all right, well, there's it's called information asymmetry. It's called, they have an edge with information. They're able to organize everything to one easy to use terminal. I'm like, I want a terminal. I don't want to pay $30,000 for a terminal, whatever these crazy numbers are. So it took me a few years. I built my own, but it's been my life's work since I think 2004 when I first had this idea. And at the time, it was way too expensive. I didn't have the money at the time, and so on and so forth. Finally, I was able to get it up and running, and now it's got everything to my liking built. So every day I can see stocks gapping up. One click. I just read to you earlier today, the week ahead. There's a calendar built into the terminal where I can see everything coming up. All the stocks reporting earnings, what day they're reporting earnings, the estimates. There's AI built into it. I can see breakouts in real time, setups in real time, breakdowns in real time. Gaps up, gaps down, all-time highs, 52-week highs, stocks moving on volume, up and down, all the things I'm looking for. I can make my own watch lists. I can use a scanner, which is extremely powerful. A screener, we can run screens and, filter out stocks, so on and so forth. And there's a lot more. It's a quote panel. You can see the market and see quotes going up and down, up and down, up and down. Any ETF, you can see all the holdings under markets. You can go to ETF and holdings and see NVIDIA's 8% of the NASDAQ 100 or Apple's 7%, whatever the holdings are and the percent weighting on that ETF. Super powerful tool. Anyway, I digress. I'm passionate about it, so I light up like a Christmas tree because, again, my life's work kind of a thing. Finally was able to get it. I still can't believe I have it or built it. But on Market Terminal, every day with earnings, first thing in the morning, before the open, I have an extended hours section. I can see the action before and after the close every day. Earnings. Right now, heavy earnings season. I can see all the stocks that are up and down before the open by 3% or more. Up, down. I can see stocks breaking out before the open, breaking down before the open. When the market opens, I can see them breaking out during the day. Breaking down is super powerful tools. Gives me an edge. Gaps. Right at the open, 5 minutes into the open, 2 minutes into the open, I can click on gaps. I can see all the stocks gapping up. Right there. One click. Before I have to scan and wait and just now it's one click, done. So I'm looking for, first thing is the reaction to the news. Second thing I'm looking for is what are the actual numbers. Third thing, consensus. What did Wall Street expect? And then the fourth thing, guidance going forward. That's really in a nutshell how I handle earnings season. And I keep track of the leaders. And just because the stock went down the first time, doesn't mean it has to, and it doesn't mean it has to stay down. Like Goldman Sachs, for example, went down when it first reported earnings, and then it rallied. And then what happened? It went right back up. Okay, so I'll take it off the laggard list and I'll put it on my leader list when it gets back above where it was before earnings. Or a stock that gaps up and kind of fades or rolls over, hey, I'll take it off the leaders list. I'm looking for leaders. I want strength. An object in motion does what? Stays in motion. So again, as I go through earnings, I want to find the reaction to the earnings. I want to find the leaders. I want to find the ones that are able to outperform their peers. The NBA finals are going on, or the NHL finals, or the Super Bowl, the playoffs in any season. Same thing with stocks. It happens every quarter. I want to find the strongest of the strong. Why? Because most likely, not always, again, nothing's 100% locked, but again, it's all about probabilities. Most likely, a stock that gaps up on earnings, on volume, and continues to rally, will continue to rally for a while. And some of the best stocks out there, the big growth stocks, the monster stocks, are the ones that are able to gap up and rally, beat earnings, beat consensus, raise guidance, and do it after several quarters in a row. And they just run and run and run. Those are the ideal scenario. I mean, that's the best possible scenario. So I believe that's all the time we have for this segment. Up next, we have a lot more to cover. Thank you, everybody, for your patience while I deal with the technical difficulties here on my end. But we've got a lot more. I'll be right back. Thank you. And welcome once again to Investor's Edge. I'm Adam Sarhan, in for Gary K. In case you're just joining us or missed any part of the show, you can go to GaryK.com, rewind, fast forward at your convenience 24/7, all for free on GaryK.com. All right, so we spoke about the week ahead, high level, spoke about earnings. 20% of the S&P thereabouts are reporting this week. We've got jobs in focus this week, and that's important because the Fed cares about jobs and inflation. Okay. I want to separate winners from losers, leaders from laggards. And during earnings season, I do this every quarter. You'll hear me say this again anytime I'm on during earnings season. Really look for those leaders. It's really important because the stocks that tend to be the monster stocks, the big leading stocks, the growth stocks, are the ones that are really, really, really just the textbook stocks are the ones that tend to raise, and raise guidance. They beat consensus. They just smash numbers, gap up, and they do that several quarters in a row. Not months, not weeks, but quarters in a row. Great action. It's textbook. It's what we look for. Not all of them are like that. In fact, most are not. But that's okay. That's what makes this fun. It makes it challenging. So, a few other things to keep in mind as we move forward. Earnings season, spoke to you about how I find them. I've got market terminal. I use the gaps up there. You can see new highs there as well, all-time highs as well as 52-week highs, breakouts and real-time breakdowns. I read Gary's notes to you. I'm just overviewing everything with you in case you're just joining us. Transportation stocks, an area to avoid, and we've got some heavy selling going on there. So let's go through some of them to show you actually what's not working and what is working. So I'm going to use market terminal here. I can click on markets. And then this under it, I've got industries and I've got ETF holdings. So I'm going to click on ETF holdings and I'm going to type in IYT because the IYT is a transportation ETF. The biggest stock holding wise from a weighting standpoint on this ETF is Uber, UBER. And Uber is down just a little bit today. They report this week. UNP, which is a Union Pacific, a railroad company, down. And that, by the way, Uber is about 19% of the IYT. UNP is about 15%. UPS got clobbered today on earnings, I believe. No, sorry, 1 second. Were earnings last week. Earnings were a few days ago. It fell on earnings. That's another good example. Rallied for a few days, reversed on Friday, and then just got crushed today, down 10.5%. Just today, and that's about 8.6% of the IYT. FedEx, FDX is a ticker there. That's down big today as well, and that's about 4.75% of the transportation IYT, the ETF, the IYT. United Airlines, UAL, down as well, down big. Let's see here, 90.25. 90. So yeah, you're about 4.69% of the IYT. That's United Airlines. UAL is a ticker. ODFL is Old Dominion Freight Trucking Company. Gary mentioned that to be careful and avoid those areas. That ODFL is 4.5%, so 4.55% of the IYT, and that's also down big. And it's been down for the last few days. Delta Airline, DAL, another transportation stock and airline. That's 4.46% of the IYT. NSC, Norfolk Southern Railroad Company. Let's see, transportation, raw materials. Yep, that's down. And again, same thing. That's about 4.3% of the IYT. CSX, another railroad company, down a little bit. No big deal. Let's see, Love, which is Southwest Airlines, LUV, down a little bit, 3%, and so on and so forth. So those are the big ones as far as the weighting is concerned. EXPD, another logistics company or a transportation stock, down today, down big, gap down. That's about 3% of the IYT. The CHRW, C.H. Robinson Worldwide, freight and logistics company, down big today, weighing on the transports. XPO, another freight transportation stock, logistics type stock, down big. JBHT, JB Hunt, I've seen their trucks around, down big. Well, not big, just down today, not big. And then American Airlines, AAL, down a little bit. And Joby, Joby, that's nothing really major. Lyft, LYFT. And now we're down to about each one of these holdings is about 1% or so of the index. So as you can see, a lot of these transportation stocks, and you look at the actual holdings, it gives you a much better picture of why that ETF is, or that index, or whatever it is that you're looking at, is down so much. Same thing with the QQQ. In market terminal, I'm going to go to markets and then ETF holdings. I'm going to type in QQQ. NVIDIA, NVDA, is 8.88% of the NASDAQ 100 right now, the QQQ. 8.8%. Apple is 7.56%. Microsoft is 7%, 7.02%. Amazon's 5.2%, and Tesla's 3.8%. Those 5 stocks, 2, 4, 5 stocks, make up approximately 30% of the index. If you add Meta and Google, another 3.75% each, thereabouts, you're probably at 30%, thereabouts. It's like 5-6 stocks make up like 30-40% of the index. That's massive. If you look at the S&P 500, SPY, you can type that in there. Again, marketterminal.com. I'm going to markets, and then under that, ETF holdings. NVIDIA, NVDA, 7.59% of the S&P 500. That's big. But if you look at stocks throughout history, it's normal to see that. Apple is 6.46% of the S&P 500 right now. Microsoft is 6%. Right now, we're at 20% of the index with those three stocks of the S&P 500. NVIDIA, Apple, Microsoft. If you add Amazon and Google, and Facebook, you're about 30, or even Tesla, you're over 30% with those few stocks of the S&P 500. It's a market of stocks. Yes, it is. But also understanding what these holdings are and the weighting gives a lot of clarity. A tremendous amount of clarity. Because when you see something like 3 stocks or 4 stocks or even 5 stocks make up, I don't know, the vast majority of the index, then all of a sudden I've got clarity on saying, oh, maybe it isn't. There's 500 stocks in the S&P, 4 of them or 5 of them, maybe let's say 5 of them make up 30% of the S&P. Well, hold on a second here. That's a complete different conversation than saying, oh, yeah, the market's down. Most every stock is down, so on and so forth. Yeah. Sometimes you see the Dow down so much, and the NASDAQ barely moves, or the NASDAQ's up. Why? Because when you look at the Dow, I'll type in the DIA so you can look at the Dow. Let's take a look. Weighting. Goldman Sachs is 11.6% of the Dow. Caterpillar, 7.58. Right there is about 20%. Microsoft's about 6%. American Express, 4.7. Home Depot, 4.48. Visa, 4.3. United Health, 4.3. JP Morgan, 4.1. McDonald's, about 3.85. IBM, 3.77. Apple's 3.2. I'm surprised. I thought that would be bigger. Amazon's about 3%. Johnson & Johnson, about 2.5%. NVIDIA's only 2.3% of the Dow. Wow, I didn't know that. Hey, you learn something new every day. NVIDIA is a big piece of the NASDAQ, big piece of the S&P, smaller piece in the Dow. Chevron, about 2%. Procter & Gamble, 1.75%. Walmart's about 1.4%, and the rest of them are, Merck is about 1.38%, and the rest of them are about 1% or lower. For the mega caps. The large caps, you've got Sherwin-Williams, Amgen, Travelers, all about 4% or 3%. So again, knowing where you are in the index, how big that stock is, the weighting on it, the impact on it on any given day, all that's available right there on Market Terminal. I want to know what's happening, and I want to go under the hood. Another really helpful thing that I look at are movers. So we look at the movers, stocks that are moving up or down more than 3%. There's 144 stocks that are moving up, 275 that are moving down. All right, that tells me there's more movers down than up. Powerful information. And by the way, that updates live in real time. You got 140, you got 150, you got 200. So 2 to 1, 3 to 1. Small but subtle sign of strength and or weakness. And by the way, I can see all this stuff before the open as well. Again, the market is speaking. My job is to listen. And I'm looking for signals, not just the noise. Why? Because it's a noisy environment. The market's very noisy, folks. There's a lot of noise out there. A lot of noise. Up next, we have a lot more to cover. I want to thank you very much for being here. This is the one and only Investor's Edge. And welcome once again to Investor's Edge. In case you're just joining us or missed any part of the show, you can go to GaryK.com, rewind, fast forward, listen at your convenience on any device, all for free. It's GaryK.com. All right, so we spoke about a week ahead, spoke about the jobs, spoke about the Fed, spoke about what I look at during earnings season, spoke about leaders, laggards during earnings, spoke about how to listen when the market is speaking. a lot happening in the market. Our job is to really just filter out the noise and focus on the signals, which is the things that actually matter. And a lot of things, I'll give you the last few minutes here, just some structure, some high-level structure. A lot of things that people focus on really just don't matter. Nothing's wrong with it. There's no malicious intent. There's nothing wrong. It's just not, there's just noise. It's not actually things that move the needle. So what I've learned to do is do my best to look at the forest and not just the trees. And what does that mean? The forest is the overall trend. Let me zoom out. Let me look at the big picture. Let me look at what the actual big trend is. You can look at yearly charts, quarterly charts, monthly charts. All of those are available on Market Terminal. You can do any way you want. But really, I want to align myself and be in harmony. That's my play on the word harmony. Be in harmony with the market. Long in a bull market, out in a bear market, or short in a bear market, however you want to adjust it. Everyone can do their own thing. But again, be in harmony with the market. And the way that I do that is by looking at the forest. Then, I might zoom in a little bit, daily charts, weekly charts, look at the trees. Intraday charts are the leaves on the trees. And most people, even daily charts to some extent, any given day in the market doesn't really move the needle in a big way over a long enough period of time. Buffett taught us think in decades. So any given day, sure, it's a matter of that day, and if you get stopped out, different story, but in a bigger picture, I was talking about the overall trend, how it impacts the forest any given day. It's rare that really is just a huge outlier. But for the most part, most days are just become blips on the radar. Again, I'm speaking in generalities here. So what matters? The longer term trend, right? But also you want to make sure that you're aligned and you have risk, money management principles, you respect risk, so on and so forth. But most people, what they're doing is they're getting caught up in the minutia, the stuff, the noise. They're looking at the leaves, intraday action or the daily action. Oh, this happened, this, caught up in the news, caught up in the headlines, caught up with what their friend thinks or whatever the case, the emotional decisions that impact every human, because we're emotional creatures. And they miss the forest, they miss the trees, they miss the forest. They're looking at the leaves on the trees. Oh, I found this extremely helpful. Zoom out. Step back. Look at the big picture. And ask myself, am I aligned with what's actually happening in the market? It's a mirror of what's inside of me. It's the market's the biggest it's ever been in history. The economy is the biggest it's ever been in history. It's the best time in the world to be alive. We have access to AI. We have access to the internet. And go anywhere in the world in a flight or two flights and you're around the world. Make a phone call in 2 seconds. You can FaceTime anybody or Zoom with anybody anywhere in the world. I mean, just tremendous opportunity. Tremendous. And what's happening? I'm sitting here fighting the market. There's always reasons to be bearish. There's always reasons to be bullish. But what's actually happening? So I want to get in harmony with the market, focusing on structure. And asking myself, A, do I have the results I want? Yes, great. If not, am I going to keep doing the same things expecting different results? That's what most people do. Or am I going to change? Do something different. Do something better. Take accountability for my actions. So on and so forth. I'm the type of person humbled enough by the market. If you trade stocks for long enough, or any really publicly traded market for long enough, you get a certain amount of humility. And you realize not only does any given day not matter in the market, any individual person zooming out really doesn't move the needle in the market. It's like standing in front of an ocean trying to block a wave. That's kind of my analogy towards it. It's like, okay, you could try, but most things just don't matter. Okay, great. So I want to have structure. I can't in any way, shape, or form impact other people's actions or whatever. It's not even part of my thought process. All I want to do is, again, looking at performance, studying excellence, is be prepared. Ben Franklin taught us hundreds of years ago, right? America's turning 250 this summer. Happy birthday. Happy early birthday. We're making plans for the 4th now. We'll be in New York that weekend, seeing my sisters in Jersey and some other fun stuff we have planned. But guess what? I'm taking the kids to see the fireworks and all that fun stuff. Ben Franklin said, if you fail to prepare, you're preparing to fail. I'll say it again. If you fail to prepare, that means if you don't prepare, you're preparing to fail. Think about a kid going in to study for a test. What do most kids do? They cram the night before. High school, college, whatever it is, right? Even work. Oh, let me just do it the last day before the deadline. Well, where were you all week? Where were you all quarter? Where were you all semester? Where were you all, do it early. Same thing with the market. I found it extremely helpful to write things down. Have a plan before the market even starts. Why? Because now all of a sudden I've got my thoughts on paper and I can check them objectively. Here's what I thought would happen. Here are the stocks that I'm focused on, because I can't watch every single stock in the market. It's not possible. Here's my focus. Like I have a universe list, and then I have a focus list, and I have a top stocks list. Okay, or some way of making sense of the market. Here's what I'm focusing on. And then actual buys. I do watch list, buy list, ready list, whatever word you want to use. Anything you want to call it. And then place the orders. Did I take the trades I said I'm going to take? Did I not take them? Why? Why not? How do I improve? Constant improvement. And then I can look back at last week. Hey, what did I think was going to happen and what actually happened? Disconnect. And then fix it. Really, that simple. And then strive for excellence and intellectual honesty. Be honest with myself. Actually, on Market Terminal, there's a cool thing that we built called AI prediction, which shows you what AI thinks will happen. There's no way, shape, or form I'm going to trade off of that right this second because it's not backtested and all that stuff. But hey, this is what AI thinks might happen. Okay, great. Another tool in the toolbox. Have structure, folks. Think of it, Michael Jordan, any professional person. Who's going to do better, the person who just wings it or the person who takes the time and prepares and has structure? And that keeps me intellectually honest. Otherwise, I'll forget. So it's really important as you keep yourself intellectually honest. Okay, great. I've learned to do that. I write it down. I can look at what I wrote down. And the best part is I can even print out my trades and have two columns. I have a winning folder and a losing folder. These trades won. These trades lost. Okay, that's fine. There's going to be losing trades. We're all human. We're all going to have losing trades. We all make mistakes. Mistakes are your teacher. Those losing trades, I learn from them. I place a trade. I write down why I wanted this trade, why I didn't. Same thing with the winners and losers, and I learn. I believe that's all the time that we have. Thank you very much for being here. This is the one and only Investor's Edge.